Yes.
Great, excellent. So I'm going to be talking to you about the context to my PhD study, which is focused on public-private information sharing regimes as part of the system to tackle money laundering. So I'm going to provide an overview of that by asking the question, co-opting the financial sector for surveillance purposes, is that what's happening? And talk you through the growth of public-private information sharing as part of anti-money laundering regimes. So there is a context to the development of public-private financial information sharing. The international legal framework for tackling money laundering is set out through some standards which are set by the Financial Action Task Force, or FATF. And those standards have been around for some time. So FATF has been around for 30 years, but the standards themselves have been updated over that time. And originally, this international initiative to set standards for tackling financial crime was born out of a concern that financial institutions were profiting out of criminality around the world. There was a particular concern at the time around narco organized crime in Latin and South America, and there was a big push to create a framework, an international framework that responded to that threat. Over time, that international framework has grown. And it's taken, different emphasis on different financial crime threats or underlying crime threats over the years. But in essence, what the standards do is they create a duty for regulated entities to identify and report suspicions of crime within their own business. So we can think of large banks as effectively massive data owners, almost on a scale of some of the IT companies and the social media companies. And they are required to analyze the activity going on in their business and to understand what the nature of crime, all crime in most jurisdictions might look like when it comes to their own visibility of that, and then report when they have suspicions of crime, and they will file those suspicious activity reports or suspicious transaction reports to a specific government agency called the Financial Intelligence Unit. So there are obligations both at a criminal level in terms of a duty to report suspicions of money laundering, and there's also a regulatory framework which governs those sectors and those regulated entities in terms of their compliance with a wide range of regulations relating to these standards. So we'd be most familiar in terms of the impact of money laundering in the banking sector, but the regulated community or regulated sectors for money laundering purposes go far beyond that. So beyond banks to professional bodies, the legal sector, the accountancy sector, Europe through the anti-money laundering directives cover those wider range of sectors. Some jurisdictions, notably the US, don't oblige their legal or accountancy sector to file suspicious activity reports. So there's some divergence around the world. Part of the challenge over that 30-year period is that this system has contributed in many countries to a growth in low-value suspicious reporting. So there's a lot of incentives for financial institutions, regulated institutions, to report. If they have the slightest suspicion or concern that they may be looking at a customer who's engaged in criminal activity, it's just better to report, because if you don't report, then you might be subject to regulatory action, compliance action, some of the fines that banks have faced from regulators for money laundering breaches in their compliance frameworks have been enormous. So there's a real incentive just to kind of file lots of reports to the government financial intelligence units. And in countries such as the US and the UK, those have been growing at over 10% a year. So it's a really significant growth in reporting. And historically, the indicators that financial institutions and others have had to use to consider whether something is suspicious have been quite broad. They might be based on things like geographic risk, so a number which indicates risk for customers from an entire country. And then that would feed into their assessment of risk and ultimately whether they file a report on that customer. Therefore, there's been the sense within financial intelligence units from the public sector side that there is a lot of reporting, a lot of it driven by defensive regulatory incentives, and therefore a kind of lack of value about real intelligence that would support law enforcement investigations against financial crime. And we can see that the broader system, to the current day, but over the last decade certainly, really struggling to demonstrate effectiveness in the fight against financial crime. Most of the estimates out there in terms of the global scale of financial crime are certainly open to criticism from a methodological perspective, but the upper estimates are around 1 trillion a year. In the UK, the National Crime Agency estimated that the scale of money laundering through the UK was in the hundreds of billions, and asset restraint, is in the hundreds of millions. So it's certainly below 1% in terms of the effectiveness in the sense of asset restraint against the scale of the estimates of financial crime, and that's similar across developed and advanced economies. So this context has driven incentives both for law enforcement and for regulated entities, this final bullet point, an interest in regulated entities to gain more understanding about law enforcement priorities, law enforcement insight into crime, to help make their indicators of financial crime and their models to identify risk more effective by leveraging law enforcement insights. And from the law enforcement side and from public authorities, there's been an incentive to enhance the quality of the intelligence that is coming from suspicious activity reports from the private sector. And that has, those two factors have really driven the development of these public-private financial information sharing partnerships, and I'll talk about them now. So you can see here are a number of public-private financial information sharing partnerships that have developed around the world. You can see relative to the Financial Action Task Force International Legal Framework, there are relatively new innovation in the financial crime space. The UK Joint Money Laundering Intelligence Task Force is considered by many to be the first initiative of this kind that really brought regulated entities, financial institutions together in a partnership, but in practice in a room together with law enforcement agencies and other public sector agencies to do two things. One, to discuss financial crime threats at a strategic level. So that would involve sharing insights about the nature of the crime, how is it growing, how is it adapting, what indicators do we see in terms of how this crime might be represented in the financial sector. And that's a dialogue, so sharing insights from public and private sectors. And then the second level is what's called tactical information sharing. So this is sharing information about specific entities of concern or entities relevant to an investigation, and usually from a public sector side, sharing those named entities with private sector institutions, regulated entities, to make their suspicious activity reporting much more responsive to the investigation. So if you can imagine a list of companies or a list of individuals relevant to serious and organised crime investigations being passed to banks and others, they then search their data holdings in response to those identifying pieces of information, and then file suspicious activity reports in response to that. So it really takes the process conceived under the FATF regime, and looks at it from reverse. It's no longer just required for financial institutions in isolation to discover financial crime, but they're given leading information relevant to investigations, and then they are required to understand their exposure to that information from their own business. So a little bit about different models. So in Canada, there's not the same legal gateway to share tactical information, but the Canadian Major Reporters Forum since 2016 has supported strategic level information sharing, but that has driven more responsive reports relevant to those threats, and there's some examples around human trafficking which are particularly noteworthy. In Australia, the model is that analysts from regulated entities, from banks and elsewhere, sit co-located with public sector analysts, and in law, through the Australian anti-money laundering legal regime, those analysts from the private sector become public entrusted officials, and they actually become members of the government financial intelligence unit, and they're subject to the same information security regime that a public intelligence analyst would be. The US FinCEN exchange, FinCEN stands for the Financial Crimes Enforcement Network, is a different model. The US is obviously a much larger financial market, much larger jurisdiction, and so there's not a permanent membership for the FinCEN exchange, and instead the US FinCEN exchange through the FIU will try to identify in advance of a partnership meeting which financial institutions are most relevant to a specific case, and they will usually be supporting a law enforcement agency with a particular case, and then they convene a tactical level briefing relevant to that case, and so therefore the financial institutions can then be responsive to that information, but there's no permanent membership. The Netherlands Terrorist Financing Task Force is an example. Europol have a partnership which is at the strategic level and is transnational. Many other countries have developed their own partnerships since 2017, and I think special noteworthy mention to Ireland, who I think have the best acronym. You can see in the anti-money laundering space that there's a lot of acronyms, ACIP, FIMLET, GIMLET, but the partnership in the Republic of Ireland is focused on, it's called the Joint Intelligence Group, so it's the Irish JIG, which I think is the best acronym that I've seen yet for these partnerships. So in terms of the study, the civil liberties implications are a key focus for what I'm looking at. So in terms of a range of those issues, so there are obviously issues in terms of privacy, private financial information, and the ability for the state to surveil that information relevant to their purposes. There are issues in terms of presumption of innocence, because the information can very often be based on limited indicators, and then those individuals can be, reported, and that information sits on a law enforcement database. Action can also be taken, so financial accounts can be closed on the basis of suspicion. So there are challenges in terms of presumption of innocence, and also the reversal of the burden of proof, because once designated suspicious by a private entity, it would then be incumbent on the individual to demonstrate their innocence and prove their innocence, and in effect reduce their risk of being an agent of money laundering in the eyes of the financial institution. We have this broader issue which exists elsewhere in terms of the privatization of law enforcement, and this is clearly an example of that, where private sector institutions acting as agents for law enforcement outcomes and activity. We have a lot of data transfers, so public, private, private to public, and private around these issues. A lot of the action is focused on preventative steps. So this engages with the literature around predictive policing, lots of challenges around the ethical nature of that approach to law enforcement, and particularly when it's actioned by private sector entities. And in the event that innocent parties are in some way affected by these actions, there are lots of issues in terms of the ability for those innocent parties to identify who's liable for the damages that may have they may have incurred, and rights of redress to respond to those damages, defamation risk for themselves if they've been designated suspicious. Moving forward, these partnerships are really investing in big data analytics, and of course, alongside the suite of challenges with big data analytics for law enforcement, there are particular issues in a public-private partnership setting around the transparency and the accountability of that algorithmic decision-making and the oversight of that process, which may be designating suspicion without a human analyst really even understanding how that suspicion was arrived at. So those are some of the issues I'm engaging with in my PhD research study.